Okay guys, Darren from Honest Money and welcome back to another video. Now in this video we're going to be taking a look at a beginner's guide to Forex. Now Forex is something that I've been trading on and off for the past few years and it's something that I enjoyed doing. It's very easy to trade with Forex, however it is very difficult to make consistent profits. So what I want to do in this video is just explain to you what I think are the very basics of Forex, because I know when I started there were so many terms flying around and trying to take them all in one go was almost impossible. So I just want to go over what I believe are the major terms that you need to know initially, and if you guys think that Forex is something that is interesting to you, let me know in the comments if you want to see more videos, or you can go away and do your own research as well. So in short, Forex stands for foreign exchange, and you've probably also seen it being referred to as FX as well. Now foreign exchange is a marketplace for trading currencies against each other. And the foreign exchange market is the largest financial market in the world. And in 2019, the average daily turnover was $6.6 trillion. Now, with it being such a big market and with it having such high turnover, it is classed as a high liquidity market. Now, what that means is that there are lots of buyers and lots of sellers, which has the knock-on effect that means that trades that you execute are executed very quickly. And it's also very small spreads. Now, I'm going to come back to spreads later on in this video to explain exactly what a spread is. Now the markets themselves are open 5 days a week for retail customers. Now the reason I highlight retail traders is that at the weekends when the markets are closed, there are still some behind closed doors trading going on between commercial entities. So the market can still move over the weekend even though you can't trade as a retail trader. And that is sometimes when on a Monday morning, or a Sunday evening should I say, when the markets reopen, there can be a gap in the market. And I'll show you that later on one of the charts that I'm going to demo. Now the Forex market itself, when it opens late on Sunday evening, this is if you're based in the UK, depending on where you're based in the world will depend on how the opening and closing of the markets align with your local time zone. So once the market opens, it is traded continuously for pretty much 5 days, so from late Sunday evening to late on Friday evening. And the reason it is possible is that one market opens and then as it closes, or just before it closes, another market has already opened. So the markets will open with Wellington in New Zealand on Sunday night, and then they'll trade throughout every 24-hour period from Wellington, Sydney, Singapore, Hong Kong, Tokyo, Frankfurt, London, and finally New York before repeating that cycle. There are other marketplaces that will open and close as well during this period. I've just tried to highlight the biggest ones there. Now in total, there are 180 currencies in the world that can be traded, and there are 8 currencies which people class as major currencies. Now almost any currency can be traded against another currency, as currencies are traded in pairs. However, depending on which broker you use, not all pairs will be available. So just because all currencies exist doesn't mean you can trade every currency as a pair. Now while I'm on the subject of currency pairs, I'm going to explain a bit more about how currencies work and how they work in pairs. So there are 8 major pairs that most people should be aware of, and any other pairs that aren't major pairs are classed as either minor pair or exotic pairs. So to give you some examples of the major pairs, you've got the Euro USD, you've got GBP USD, which is also known as cable, you've got the USD versus the Swiss franc, and USD versus the CAD, which is the Canadian dollar. Now an example of some of the minor pairs will be based on the majors that I showed you on the previous slide, but not traded in the way that these 8 are shown at the moment. So for example, Euro versus GBP, despite the fact they are both major currencies, as are not classed as a major pair, they are seen as a minor pair in this instance. Now for an exotic pair, these are some of the lesser known currencies, and the trade-off with the exotic pairs is as there is less people trading them, there is generally less liquidity in the market. So quite often it will take longer for trades to be executed and the spread itself will be bigger, which again, like I said, I'm going to come back to later in this slide what the spread actually is. But all you need to know at the moment is there are 8 major pairs that you should be aware of, and most other pairs that you've probably heard of you should be able to trade with most Forex brokers. Now the pair itself is made up of 2 currencies. You have the first currency, which is the base currency. So if we take GBP USD as an example, which is cable as I just mentioned, GBP is the base currency. Now the second currency is the counter or the quote currency. So with the GBP USD, the USD is the counter currency. So with a currency pair, you will have 2 prices. You'll have the bid price and the ask price. Now the bid price is what you will pay if you want the market to go up, and the ask price is what you will pay if you want the market to go down. So the best way to remember is that the bid is your buy price and the ask is your sell price. Now the spread is the difference between the bid and the ask price. So for example, this is from a trade earlier today. The spread was 0.9 pips because the bid price is 124473 and the sell price is 124464. Now this is actually only a 4 decimal place currency, so this is why I just want to show shown as a tiny number up here. So this number here refers to 1 whole pip. So the difference between that and that is 0.9, because it's not quite 1 pip, because it's 6.4 to 7.3. So the spread is the difference between the bid price and the ask price. Now the reason it is really important to try and get as small a spread as possible is that is the money you instantly lose when you enter a trade. So once you enter a trade, that market then has to move that amount before you are back at a break-even point. So on this trade, the market had to move at least a minimum of 0.9 pips in my favour before I arrive back at the break-even point. And finally, just to clarify exactly what a pip is, well, the pip is a percentage in point, which is a unit of measurement which shows the price movement of a currency pair. And it's usually the second to last decimal place, depending on what platform you're using and depending on what broker you're using. But generally speaking, it'll be the second to last decimal place. So this would count as 6.4 pips, or 6 pips and 4 pipettes, and this would be classed as 46.4 pips. Now the next thing I want to look at is what bulls are and what bears are and what it means when you go long and when you go short. You've probably heard this in many films. You've seen bull markets and bearish markets, or someone going long. It's very, very simple, so I'm just going to go through it. So you have bulls and bears. Now in a bull market, investors expect shares or forex or whatever it is, the commodity itself, to go up. So in a bull market, you want to buy low and sell high. So if you believe the price of a currency pair is going to go up, then you're seen as being bullish. However, in a bear market, investors buy high and sell low. So if you believe the price of a currency is going to go down, then you're seen as being bearish. Now the easiest way to remember it is bulls have horns, and the bull's horns go up, so you're being bullish. And with a bear, the bear attacks by pushing his paws down, and so the bearish market is pushing down. Now with long and short, it's pretty much the same thing. So if you take a long position, so if you're buying a base currency to sell the counter currency, so if you're buying GBP to sell USD, then you want to see the price go up. Whereas in the short position, when you're betting against the market, you're selling the base currency, so you would have been selling GBP and you've been buying USD instead, then you want to see the price go down. So hopefully that clears up what bulls and bears are and what it means if you take a long or a short position. We then move on to leverage and margin. Now leverage sounds quite scary because basically it allows you to trade with more money than you actually invest. However, as the currency pairs tend to move in such small movements, it is usually required to have leverage, otherwise you won't be able to make very much return on your money at all unless you've got a huge investment. For example, if you have a leverage agreed with your broker of 10 to 1, if you deposit £1,000, then they will allow you to trade up to £10,000. So what I've got here is a table of example leverages. So for example, if you've got a 20 to 1 leverage and you deposit £1,000, then your exposure is up to £20,000. There's a few examples there of how leverage can work depending on what leverage agreement your broker offers you. Now the margin, which effectively is your deposit, is the amount of money that you give the broker to allow you to trade. So if you've agreed with your broker on a 50 to 1 leverage, you need to give them £1,000 as your margin before they'll allow you to have up to £50,000 to trade with. Now as you're trading with a leverage, you can be hit with what's called a margin call. And a margin call is what happens when the trade you have open, the risk you have open on those accounts, so when your trades start going south on your account, if the potential loss is more than your deposit, then that is when you'll get a margin call. So for example, if you've deposited £1,000 and you've got £25,000 worth of trade open, and combined those open trades look like they're going to lose more than £1,000, then you will receive a margin call and you would have lost that whole £1,000 deposit. Trading with leverage is risky, so it's very important you work out a trading strategy and a risk management strategy that works and is a suitable risk for your leverage. However, you should also bear in mind that many brokers offer negative balance protection, so that in theory it shouldn't be possible to lose more than your initial deposit. I say in theory because some brokers have small print, so always check the small print to make sure it's not possible to lose more than your initial investment. One thing that you'll probably come about on various websites and forums are discussions about what type of trader people are and what type of trader that you want to become. You know, people will talk about being a fundamental trader or a technical trader. So what I want to do on this slide is just go through all three of these to give you an idea of what they are. So a technical trader relies on the analysis of charts and graphs to spot patterns that may give a buy or sell signal. So I'm going to show you a chart in a moment which will give you an idea of some of the things that technical traders use to analyze a chart to try and predict what is going to happen. Some of the most popular things that a technical trader will look at are candlesticks, support and resistance levels, and various chart indicators, and there are hundreds of different chart indicators that people can use. You then have the fundamentals of the market, where you have traders looking at the political, social and economic data that could impact the value of a particular currency. Some of the things that they will look at are the GDP to see how well the country is performing, maybe what the interest rates are like in the country. If they've recently been cut, then the chances are the currency may go down. If interest rates have gone up, then there's every chance that that currency will be getting stronger. And there's lots of other fundamental data that traders will look at to decide whether they believe a currency is going to go up or down. And then finally, you have market sentiment. So sentiment traders are looking at the market as a whole to get an idea of which direction it's going. They might be looking at volumes of trades to see how many traders have taken a particular position. If lots of traders are going short on a particular currency, then they might see that as market sentiment, and they're expecting that currency to go down. So there's no right or wrong answer to choosing what type of trader you want to be. I've seen traders who are purely technical and refuse to trade on fundamentals because they believe anything that happens from a fundamental perspective will be reflected in the technical charts, and so they can just rely on analysing the charts. And whereas I know other traders who rely on all three, they'll look at technicals, fundamentals and sentiment before placing a trade. There is no right or wrong answer. It comes down to finding the type of trading style that is suitable for you and what feels comfortable with the risk that you want to take. Now, if you're still with me, thank you for watching the video this far. If you're finding it helpful, please hit the like button. It makes a big difference. And if you want to see more Forex videos or anything to do with personal or business financial advice, make sure you subscribe to the channel. So up next, we're going to take a look at some Forex charts to give you an introduction to the charts and how they work and what they all mean. And some of the things I'm going to cover are candlesticks, support and resistance levels, indicators, gaps, placing a trade, stop loss and take a profit. So these are some of the very basics. So I'm going to run through these on a live chart to show you how they all work. So what I've got in front of me is quite a stripped back live chart of GBP versus USD on the 1 hour time frame. Now there are lots of different time frames you can view this on. This is 1 hourly. You can go down to 15 minutes or even 1 minute, and you can even go up to 4 hours or a day or a week or a month. But for this at the moment, I'm going to stick with the 1 hour just to give you an example of how it all works. And what I'll do is I'll zoom in slightly so you can see things a little bit clearer. Now with all of these charts, you can customize them to look however you want. Now I customize them, so I like green for positive, so green for up, and red for down. Now on any of these charts, the first thing you'll notice are candles. So let me just give you a very brief introduction to what a candle is. Now there are 4 data points that you need to be aware of when looking at a candle. The first data point is the price point when that time interval opens. So for example, if we take this red bar here, this top line here, as it's going down, will be the price at which this time interval open. So on this was the start of the hour, the price. Now during this hour, the highest that the price got to was the top of this line, and the lowest the price got to was the bottom of this line, and the bottom of the bar reflects the price point at which this session closed. If we take another one, for example, so if we take this green one here, so what this means is at the start of this hour, the price was there, and then at some point the price got all the way down there before recovering all the way up to the top, and then finally finished there. It could have been the other way around. It might have shot up first, come back down, and finished there. But either way, all we know is the price went from there to there in that duration of an hour, and during that time it also got as high as that and as low as that. And you can see the same with any of these candles. If we pick another one here, this red one for example, so we know the hour opened here and it finished there, and during that hour it got as high as this point and as low as that point. And the green just means it went up and the red means it went down. And again, you can customize these colors to whatever is suitable for you. So that's a very basic introduction to candlesticks. Now there are lots of different types of candlesticks or candlestick patterns that can be interpreted in different ways, but that is for a more advanced video. This video is literally just to give you an introduction to the charts and what candlesticks are. Now the next thing that I want to take a look at are resistance levels and support levels. Now what you'll find in a chart are usually repeatable levels where price is either supported or it's resisted. So for example, if we look at this section here, which is over the past couple of days, we can see there is definitely starting to form a pattern of highs and lows where price is reacting. So we can draw these in as lines. So if I'm just going to draw a couple of lines on this graph very quickly, they won't be in the perfect positions, but it will be alright just for this demonstration. So we know roughly that's the highs and lows of that range. Now if I zoom this back in slightly, you can see here that the price has been resisted at least 3 times and it's been supported twice and possibly yep, I think I would class that it's been supported 3 times. So at the moment we have quite a good range. This currency is currently ranging back and forth between these 2 price points. Now earlier, as a purely example just for this video, I entered a trade when things were heading down here, as based on the ranging I'd seen so far, I was expecting it to come down, and sure enough the trade did come down. And you can see there where I entered the market, what stop loss I used and what take profit I used, which I'm going to come back to in a moment. Now when I was talking about the market closing at the weekend, you can get gaps in the market. That's what I want to show you here. So I'm just going to zoom in again. Now you'll see normally where a candle finishes for this session, so this session it went up, and then the next candle will immediately start where the previous candle finished. However, sometimes, for example here at the weekend, you'll get a gap in the market. This can also happen when the markets are open and it's super volatile. This is a good example of how the market can move over the weekend. So I wouldn't necessarily recommend holding trades over the weekend unless you're working on a long-term trading strategy. So that's how gaps in the markets can occur. Now the next thing I want to talk to you about are indicators. Now there are hundreds of indicators about. One of the most popular is called the MACD, and if you put it on the chart you can adjust all of these values, but again that is for another video. I just want to say that indicators in general, they can present information in a different way to candlesticks and hopefully give you a better idea of where the market is going to be going. So this is the MACD indicator, and like I say, there are lots of indicators you can use. So if you see the term indicator comes up, what it means is an additional piece of information in a visual way that will help you make chart analysis along with your candlesticks. And the final thing that I want to show you while I've got this chart open is just a basic trade and showing you what a take profit and a stop loss are. So at the moment we can see here this little black box, this is the price, this is the live price as it's moving. So we know the price is here at the moment. Now it's very difficult to know where the price is going to go because we're not sure whether this has bounced back and is heading back to the top or whether this is just ranging somewhere in the middle. But let's say for example we believe that this was going to continue to the very top. So what I would do with this platform is I would right click on GBP USD, as that is what we're trading on this chart. I'd right click and choose new order. The next thing I would take a look at is where I would want my take profit to be. Now realistically I wouldn't want to aim too high because we know this is typically a level of resistance at the moment, so your take profit should be somewhere around here, and then you have your stop loss, which you want to be less than your potential reward. So you don't want to be operating a one-to-one risk reward strategy because that means you have to have over a 50% success rate. So if you can operate for example a 2-to-1 risk reward strategy, so with each trade you're hoping to make twice as much as you would lose if you lost a trade, then you've got a much better chance of making money in the long run. However, a risk reward strategy and a trading strategy is for a separate video, as it's much more involved in that. So let's say for example I wanted to take profit around here, so I'm going to say 125.05 is where I want to be. So let's just put that in and we can adjust it. So 125.005 is roughly where I want my take profit to be, and my stop loss, like I say, if I want to make twice as much on my trades, I wouldn't have my stop loss too low, so I might have it super tight. However, if I was trading this from the bottom, my stop loss would be probably just below this line with the aim to push in all the way to the top. But for this instance, I'm going to go with somewhere probably just below this candle, around the 1244.20. So 1244.20. And the volume doesn't really matter, but you choose how much you actually want to buy or sell, and then we are buying. So we want this to go up, and you'll see here this has put 3 lines on the graph. We've got our entry point here, which is where we've just entered the trade. This is the price at when we entered the trade. We've got the take profit, so if the trade moves up to this line, it will automatically close. Now you don't have to put a take profit in, but with a good trading plan you should know how much you want to make from a trade before you make it. So you have your take profit in place, and then you have your stop loss as well here, which if the price drops below, it will automatically stopped out and that trade will be closed off and you would have taken that loss. So that gives you a very, very brief introduction to charts, how they work, what support levels are, what resistance levels are, what candlesticks are, your price entry point, your stop loss and your take profits. Those are some of the basics you need to know. So going back to the presentation, and the final thing that I want to discuss with you are brokers and software. Now you need a Forex broker as they allow you to speculate on foreign exchange price movements in the interbank market. Now there are 2 types of Forex brokers. You've got what are called DD brokers, which are dealing desk brokers. Now with these type of brokers, when you make a trade, quite often the trade will be filled against another trader also using that broker. So rather than trading across the interbank market as a whole, you're trading against other people with the same broker. If there isn't anyone available with that broker to offer an opposing trade, you may find that the broker themselves are the person you are trading against. You then have the no dealing desk brokers, where you never trade against the broker themselves or anyone else using the same broker, and with those brokers the trade is passed directly through to the interbank market to find an opposing trade there. Now you need a broker and a trading platform to be able to trade currencies. Now many brokers will promote their own trading platforms, however usually many of these brokers also support third-party platforms such as MetaTrader. So the platform I've been using in this video is MetaTrader 4, and I've been trading it with IG as the broker. So if you want to try out Forex completely free, you can sign up with those guys. I have no affiliation with IG. I've just used them as an example for this video. You can download MetaTrader 4, you can set it up exactly how you want, and you can trade with a dummy account through IG. I think they give you a $10,000 dummy account completely free. So hopefully you guys found this useful. Hopefully you understand Forex a bit better. If you want to see more videos on Forex or anything else to do with personal and business finance, please make sure you're subscribed to the channel. And if you haven't already hit that like button, please make sure you do. It'll be massively appreciated. And I'll see you guys in the next video.